Are you thinking of purchasing an investment property? Leasing mortgage loans, tenant-landlord relationships, and property management are all key components of purchasing a rental property. It can be lucrative to buy real estate, but this investment is not without its challenges. Hello and welcome back to the Finance Guardian channel. The rental property market can be a great source of income that appreciates over time. According to Census Bureau statistics, approximately 48.2 million rental units are located in the United States. A third of those units are owned by individual investors, including a large number of single-family and duplex units. So if you want to be one of those investors in rentals, stay tuned till the end of the video because we'll talk about how to invest in rental property. Hit that subscribe button and the bell beside it and let's get started. What type of rental property should you buy? Determining how much money you can spend and whether to buy with cash or a mortgage is one of the most important factors in deciding whether to invest in rental property. If you're considering financing, lenders will look at your credit score, down payment amount, debt-to-income ratio, and whether or not you'll use the equity in an existing home as seed capital. Rental property can be a great opportunity to grow your wealth as long as they make financial sense. It is important to estimate the rent you can charge to create a realistic cash flow plan as you compare the benefits and drawbacks of various real estate investments. Do the math to see if your monthly income can cover mortgage payments, insurance, and unexpected expenses. A clear understanding of your goals and objectives may also assist in deciding which rental property to purchase. Do you intend to use the house occasionally and rent it out for the rest of the year? Or would you like to invest in a property that can generate a passive income that could eventually become your only source of income? A talk with a certified financial planner may also help you achieve your financial goals, especially when you're just beginning to know the ropes. Search for a good rental property. Investing in properties is not for everyone. Apart from finding a property within your budget, a real estate investment should be something you can mostly manage on your own. Taking time to understand different types of properties will help you determine how to proceed. The long-term profitability of a rental property is heavily influenced by geography and demographics. The ability to evaluate a property can mean the difference between making a profitable investment or filing for bankruptcy. So first you need to examine the neighborhood. In real estate, neighborhoods can be divided into three classes based on turnover rates, with Class A being the neighborhood with the lowest turnover rate, Class B having a moderate turnover rate, and Class C having a high turnover rate. A property's long-term profitability can be determined by its neighborhood, so find out if it's safe and if there are any ongoing redevelopment projects and vacancy rates. Second, locate nearby establishments. Institutions and establishments like clinics, hospitals, pharmacies, schools, police stations, and malls can boost a rental's value and make it more attractive to tenants. Third, examine the demographics. Demographics can affect your earning potential as a landlord. For example, does the area have a high concentration of students or families? You will likely have a steady stream of tenants if it's full of students, but you will also have a higher vacancy rate. On the other hand, it might be wise to choose properties with multiple bedrooms if the majority of the residents are families. And lastly, pay close attention to the interior and exterior. Examine the interior and exterior thoroughly for work that needs to be done now and in the future. Do not invest in properties that need noticeable repairs or complete renovations unless you're focused on the fix and flip strategy. Financing your rental property. Loans for rental properties follow the same path as mortgages for primary residences, except for a few key differences. Typically, lenders charge higher interest rates on rental properties because of higher default rates. Several types of mortgage loans are available to investors, including traditional mortgage loans, FHA loans, and VA loans. Applicants for rental properties may face more stringent underwriting standards. Credit score, down payment, and debt-to-income ratio are all factors considered by mortgage lenders. Despite the same factors applying to rental property mortgages, the borrowers will likely have a higher minimum down payment and credit score requirements and DTI threshold. If you're ever wondering whether it's better to buy with cash or finance an investment property, the answer to that depends on the investor's financial situation and goals. And keep in mind that discrimination in mortgage lending violates the law. The law enables you to take action if you believe you have been discriminated against due to your racial or ethical origins, religion, sexual orientation, marital status, use of public assistance, disability, or age. You can report this to the Consumer Financial Protection Bureau or the U.S. Department of Housing and Urban Development (HUD). Protecting your rental property with insurance. Typically, lenders will require homeowners insurance to give you a loan. Property types, locations, and other factors determine the amount of coverage required. There are many great homeowners insurance companies offering affordable rates. Check with your insurance provider for discounts that might be available. In some situations, homeowners insurance will suffice, but landlord's insurance is recommended for investors looking to invest in long-term properties. Landlord's insurance is a more extensive add-on that covers additional costs associated with owning a property. Some property owners have also suggested renters insurance to protect themselves from potential disputes. Pros of rental properties. Number 1. It's a reliable exit investment. A rental property is a real estate investment. They are reliable since you can sell them at any time. Although there are no fixed rules, holding it for as long as possible is a good practice. As a result of property appreciation, you will be able to sell your property for a much higher price than you paid for it initially. Selling your property will be an exciting and profitable endeavor, no matter how you do it. Number 2. Tax benefits. According to the Internal Revenue Service, you can deduct many expenses associated with a rental property under ordinary and necessary expenses, improvements, and depreciation. In other words, you can deduct your insurance, mortgage interest, maintenance costs, and physical wear and tear on your property. You can have positive cash flow from rental income minus expenses but leave with a net loss of tax purposes. In any case, you should remember that depreciation also impacts the cost basis of a property when calculating capital gains. Several tax benefits also exist for landlords as a result of the 2017 Tax Cuts and Jobs Act. As long as your total taxable annual income from all sources after deductions is less than $250,000 for singles or $500,000 for married couples who file jointly, you may deduct 20% of your net rental income if your flow-through entity is operated as a sole proprietorship, limited liability company, partnership, or S corporation. Number 3. It provides diversification. The real estate market is a valuable portfolio diversifier that can replace stocks and bonds that make up most investment portfolios. The latter provides a steady income, while the former is responsible for long-term capital appreciation. Since monthly rent collections can produce consistent payouts similar to bond yields, when bond yields are low, as they have been for more than a decade, steady real estate cash flows can provide a well-needed boost to lagging fixed income yields. In the same way, stock market movements do not affect real estate values. As a result, real estate is a defensive component of any portfolio. Cons of rental properties. Number 1. It is not immune from rising taxes and insurance premiums. Despite your mortgage's fixed interest and principal, taxes may rise faster than rents. Natural disasters have also increased insurance premiums. Number 2. Dealing with difficult tenants. Despite your best efforts to screen prospective tenants, you might wind up with tenants who are not ideal. For example, they may be demanding or needy, late with payments, forget to turn off the water, and so on. There is also the possibility that they may be destructive, in which case the depreciation allowance in the tax code may be insufficient. However, the standard lease form can be modified to include rules about occupancy, pets, smoking, tenant insurance, etc. You may also want to consider a security deposit. Number 3. Landlord roles. Everyone isn't cut out to be a landlord. You may feel shy about raising rents or protective of how others treat your property, which can lead to disputes. There is even a possibility that you will become friends with your tenants or that they may already be family or friends to you. You may receive rent well below market price or end up with an undervalued property if you aren't firm about increases or property care. Number 4. Upkeep. Keeping a property in good condition requires both minor and major repairs. Some property owners can save money by doing the work themselves. However, most people lack the skills, time, or tools to do the repairs. Also, expect to pay contractor fees periodically. And that's all the time that we have today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new around here, subscribe to our channel to remain updated about all of our future videos. We'll see you next time.